With all of that, I do want to get a take on people who follow these type of movements very, very closely, whether this is a time to step back and pause or get out of Dodge. We've also got Kathryn Rooney Vera here, both to capital markets, both geniuses, so I appreciate it. You know, Kathryn, we started the day before the markets opened with a surprisingly good news on the claims front. I say good news from where we used to be, where these were regularly over 1,881,000 in the latest period, a lot fewer claimants than thought. The trend, again, continues. Those with continued claims down 2 million from what people thought they would be. So that looked good going into trading. And then all hell broke loose. Now, when you see something like this, what do you tell your clients?
I tell them it's an opportunity to buy, Neil. I think that this is, as Teddy correctly said, this is a pullback and a dip. And I think we need to take into consideration, Neil, what brought us to Apple rising 100% from its low, what took us 50% higher in the S&P from March 23rd. And the answer, Neil, is the Fed stimulus and federal government stimulus, neither of which is going to end anytime soon. So if we don't get what I fully expect to occur, the cash that's waiting with breathless anticipation on the sidelines for a dip, a comfortable dip, I call it, of this magnitude, 3%, 4%. It's not a meltdown. So I think guys are going to step in. I expect that to happen today and tomorrow. And I think if that doesn't happen, then the Fed steps in. The Fed has shown us that they're willing and able to back up the markets. They're already buying high yield bonds. They'll increase their high yield bond purchases. And if this continues in the downside, I personally don't think that the Fed would discard buying equities.
You know, Kathryn, Ted touched on the possibility of a correction, which is, a 10% fall off from highs, which for the Dow would be, another 2,800 points or so, if that were to be true. But what do you tell investors that, Kathryn, who've had these big gains in some stocks, at Apple, let's say they're lucky enough to hold Amazon or Microsoft, some of the big technology giants, you don't lose money until you sell. So I get that. It's all on paper for the time being if you don't move. So what would you tell them to do?
So what we've been telling them to do is to rotate away from tech, because tech since 2017, Neil, is 5 specific names, actually, and we all know what they are. The 5 biggest tech names are the ones that have taken the markets higher. If you discount those 5 names, the markets are flat. So it is those names that have really taken the markets to where they are. So we're recommending a rotation to industrials, which hasn't done as well, and to banks. Those are the ones that have really pulled up the rear. Energy, less so, because it's such a highly volatile asset, specifically oil. But I'll differ with Teddy. I think this is the Fed moving the markets. I think the Fed is largely manipulating the markets. We've seen that both in treasuries, mortgage-backed securities, and now in investment grade and now high yield bonds. So I think the dislocation between a 10% unemployment rate, 30 million people still claiming unemployment benefits, and a market at all-time record highs can only be attributed to both fiscal and monetary stimulus. And let's not forget that and this comes from the BLS, the Bureau of Labor Statistics, 30% of people's personal income now comes from the federal government. So consumption heretofore has been pushed by the government. So this is a pernicious cycle, I think, that is fundamentally wrong. But the opportunity cost, Neil, of not being in the market is too large.
All right. We'll see what happens. Kathryn, I want to thank you. Ted, thank you.